My name's Julie Dillion. I'm a CPA at EisnerAmper. I do taxes for what we call our private client services group, which is small businesses and small business owners. I do have some corporate entities I also do, but my focus is primarily on small business. I work on clients anywhere from, $20,000 worth of revenue up to $50 million worth of revenue. So we cover the gamut. If you've not heard of EisnerAmper before, it's probably because we merged into EisnerAmper, formerly Hughes Pittman Gupton. So, which is, if you're from Raleigh, you may have recognized that name a little bit better. Hughes Pittman Gupton was here for over 40 years as a sole firm, all by itself, one office, and we merged into EisnerAmper last February, so it's been a little over a year. We have a table right outside, so if there's something that I don't get to while we're talking today, or that you think about later, we'll be here all day. My colleague Leonard is also out at the table. He's also taxed, and he also works PCS, so we're here to answer any questions you might have. So some of these things I'm trying not to overlap too much that Smith Anderson talked about, but we are going to probably touch on some of the same kind of topics, just more tax related than legal related. We're going to talk about some accounting basics and what I call good business hygiene, accounting software and support and how important that might be. 1099 process, which a lot of people fail to comply with and why it's important. Sales tax, which can be really confusing and very cumbersome. Estimated payments, when you need to make them and why. And then tax consequences of entity choice. We're going to talk about that just a very little bit because Smith Anderson did a really good job of covering that. And then if we have a little bit of time at the end, I'm going to talk about what the tax outlook is right now. That can change any day, any moment, but we can talk about what it kind of looks like right now. So, good accounting basics and good business hygiene. Building a business plan, really important. A lot of people jump into business and don't think ahead. There's a lot of things to think about whenever you do it. If you're a sole proprietor, you have no legal formation, which is generally how it all starts. Somebody has a great idea, they're creative, they want to jump into it, that's how you start. Again, you don't have a business plan ahead, so what are you going to do for futures, for goals? Do you have short-term and long-term plans for financial and growth? So the Small Business Administration is fantastic with helping small businesses build a business plan and make it realistic. I worked with a lot of clients that jump into a new business and then they feel like, oh, I'm going to make money in year 2 or year 1 even. And often it takes 3, 4, 5 years before you make money. You feel comfortable, something that can actually replace what you left in your career. So take the time, use the resources that you have available, tap into the Small Business Administration, build a business plan, start thinking about what your long-term and short-term goals are, both financial and growth. If it's just you and you're just going to do your business, you have creative, you've got an art business maybe, and it's just you. You never have any anticipation of having employees. That's a totally different mindset than if you want to be in a growth track where you want 5 years from now to have 10 employees. And then that leads you to, what should I do as far as entity choice as well? So think about what Smith Anderson talked about, the different options for entity choice. And like I said, we'll talk about that a little bit more on the tax side a little later. The biggest issue I see with small businesses, separation of business versus personal. Commingling of your personal bank account and your personal credit cards with your business. It makes for very, very messy end of year, and it's really, really hard to track. And if the IRS comes in, it's very hard to support because you've got things commingled. So I often tell new business owners, make sure that you set up a business bank account, checking account, separate from your own. It can be with your own personal bank. It doesn't even have to be a business account because they'll charge you extra fees for a business account. It could be a personal account. Just make it a separate one. Get a separate debit card for that account, and then get a separate credit card that you're going to only use for business. Because when the IRS, heaven forbid the IRS ever comes in for an audit, the first thing they're going to ask for is bank statements and credit card statements, because that's unbiased third-party information. So they use that as the basis for their audits. So if you can say, look, everything I do runs through this one credit card, this one bank account, and on this one debit card, it's easy to hand them that stuff and say, okay, I'm done. and then they start asking their questions. But that's what I tell people. And then other small business issues that I see if you commingle is, people are always saying, well, people are taking expenses that they shouldn't be taking, personal expenses. I actually usually see it the opposite side. People are way more conservative, and they miss expenses that they could have deducted, that they've spent on business stuff, that they haven't because it's in their personal bank account. The other thing is, pay bills timely. You want to be able to have some sort of tracking mechanism, same as you do for your personal. You need to keep track of your business bills. You don't want to have late bills. You don't want to have defaults. You don't have things like that, because if something comes up and you do need to go to the bank for a line of credit or an extension of your credit, you need to prove to them that you paid your bills timely, and you don't want to end up having that reflect on your personal credit report as well. Again, tracking expenses accurately. That's a lot easier if you've got a separate account and you're tracking that thing separately. And then hiring the right advisors. A lot of people jump into a new business. They've not talked to an attorney. They've not talked to an accountant. They've not gone to their bank and had discussion with loan officers there on what they need to have in order to get loans should they ever need it. And then if you're going down the road that you may have an investor, you need to have all that stuff in good working order, because that investor is going to walk away if you don't have everything in good order. And then the other thing I tell folks is put back 3 to 6 months worth of expenses. I have some clients, especially post-COVID, that are very, very staunch about 6 months because they know what can happen during something like that. I think that was a big eye-opener for a lot of businesses who run month to month. So put back that 3 months minimum. 6 months is a lot more comfortable, especially if you're leaving a career to start your own business. Put that aside ahead so that you have the time to grow your business and not worry about, am I going to make enough money to live on? One thing that is really, really important in the accounting world, especially for your tax accountant, me, choose some accounting software. Don't depend on an Excel spreadsheet with a pile of receipts. And there's free out there. There's free software out there that works fairly well. Wave is out there. It is a free accounting software. It's not robust. It's not fantastic, but it gives you the basics. And if you're just starting up and you don't want to spend the money on a piece of accounting software, it's not a bad choice. QuickBooks is generally what people go with to start their business. I have companies that are running $50 million of revenue and still using QuickBooks. They use an enterprise version. They don't use the base version, but they still use QuickBooks. There's a lot of other options out there as you grow. You can choose Sage products. You can choose QuickBooks Enterprise products. You can do NetSuite. You have all kinds of options as you grow. But as a small business owner, make sure you choose something that is user-friendly and inexpensive, because you don't want to be spending all your money on your accounting software. And I have a lot of clients that are kind of in that mid-range that are looking to upgrade their accounting software. And they come to me and they say, okay, what's our next choice? What's our next option if we want to leave QuickBooks? Well, your next choice from QuickBooks at $3,000 to $5,000 a year max, kind of. Enterprise is a little more expensive. Sometimes you can get it cheap enough for $100, $150 a month if you're on a smaller version. Well, the next step up is $25,000 a year, NetSuite or Sage products. So there's a huge gap in the middle where there's not a lot of service. So keep in mind that, like I said, use accounting software, absolutely use it. Just get something that's right-sized for you. Don't think that you have to go into this really expensive accounting software to be able to do what you need to do. There's lots of different free training sessions out there too if you're a QuickBooks user or want to dive into QuickBooks. It is not a great, as an accountant, I don't love QuickBooks, but it's the right size for most small businesses. So that it can get you what you need out of there. But like I said, a lot of times there's free training, free tutorials. If you pay the little bit of upgrade, you have free one-on-one. You can call them and get questions answered. And the second step is knowing when to hire help. It's totally fine if you're a small business and you think you can handle all your accounting needs by yourself, but at some point you're going to need an accountant that can help you. So you need to sit down and think hard about whoever you use now. Do they, for your tax returns, your personal tax returns, do they handle business tax returns? Can they answer your questions if you have accounting questions for your accounting software like QuickBooks? Do they have people in-house that can help you with that? So you need to start thinking about, as your business grows, is your current advisor, accounting, legal, tax, are they the right size for your business? Can they handle your growth? A lot of the clients I get are because they've outgrown their existing CPA. They've used the sole practitioner, their family accountant for years and years and years, but a lot of times they can't handle the growth of a business and help them advise them other than to just put numbers in boxes for their tax return at the end of the year. So choose wisely, ask questions, ask friends who they use, get referrals, especially in your own industry lines. It's really important to have somebody to help you, especially if you're in a growth phase. The other thing is learning what reporting you need to run your business in a knowledgeable way. So oftentimes new business owners don't understand a financial statement and what it can do for them. So it's really, really important for you to spend some time with your advisor and learn what to look for. Because a lot of people just sit down and look at, okay, I made more than I spent this month, so I'm doing good. But what does that really mean? And how much do you need to live on? And how big does that gap need to be? So it's really important that you get somebody who can help you with that, whether it be our firm, another firm in town, small practitioner. There's a lot of small practitioners in the area that are really good business advisors. But you need to have somebody that can explain to you, what does a P&L look like? What should it look like? What does it mean? What does a balance sheet look like? What does it mean? Those things are really important for you as a business owner so that you know where your growth is. Let's say you have projects that you work on. I work on a lot of contractors. So they need to know individually on those contracts how much money they're making on each one. And if they're losing money on one, they know the next time they bid on that type or that contract with that customer that they need to adjust their expenses in some way or their revenue in some way in order to make it profitable. So when you're working with project-based kind of contracts, or even if it's creatives in the room, I don't know if we have any artists here, but if you've got a specific thing, if you're doing graphic arts for a specific client, you need to know, I did this project, this type of project with that client, and I didn't make enough profit on that. So next time when I have that same type of project, I need to increase my fees or cut back on some of my expenses. Basic accounting software, the needs that software that can help you is, reconciling cash accounts monthly, really, really important. If you don't balance your bank account personally, you probably need to learn to do that with your business. Reconcile your loan accounts monthly. A lot of times I see clients who they pay if they've got a small business loan, they pay the loan, they never book the interest separate from the principal. So at the end of the year, it looks like their loan has come down a lot more than it really has, and they've missed an expense. So I make that adjustment on a lot of different clients' books. It helps you to know when your bills are due and paying them on time. And it also helps you to set up a process for collections. If any of you have ever used any packages of software, accounting software, when you open up your first page, often there's a dashboard that says, X clients owe you an X number of dollars, and it is 15 days, yeah, see your head shaking, 15 days past due, or you need to pay these bills. They were due last week and you didn't pay them. So, you can set up your dashboard in your accounting software to help you with that kind of thing so that you make sure that you've got it all covered. I see some head shaking as far as software questions. Who's using QuickBooks right now? 2, 3, 4, 5, 6, 7. So quite a few of you. Who's using the old Excel and the Primo method? One, yeah, a lot. And that's okay to start out that way, but it doesn't allow you to plan, and it doesn't give you a true financial statement, and the bank isn't going to like it if you want to go get a loan. So, you need to start thinking about, what do I need? And like I said, Wave is free. You can Google it. It's freeware. I have a handful of clients who start out using that at the beginning, and it works fine. And it'll get you a financial statement. So that's really, really important if you've got to go to the bank for some money. Or if somebody else wants to partner with you. They're going to know what you look like. And they're not going to know that unless you have a financial statement that you can pull out. Cool. 1099s. I'm sure many of you receive 1099s. How many have gotten a 1099 in the last 3 months? Yeah, quite a few. How many of you actually have sent 1099s out? One. That's it. Okay. So they're important. Really important. The bigger the company grows, the more important they become. So 1099s are designed to report income to what we call independent contractors. Independent contractors are people who do work for you, but they usually do work for other people too. They are not your employee. There is a very legal difference between an employee and an independent contractor. In fact, there's hour-long CPE webinars you can take on what the difference is. Cool, perfect, perfect. So you have an employee, they get a W-2. If you have an independent contractor, they get a 1099. There's a very big difference there. When you have a W-2, you've got payroll withholding you have to cover. Potentially you have issues with benefits, workers' comp insurance, things like that you have to think about when you have an employee. A 1099 is somebody like, they come in and they do a project for you. So you're one of our creatives, right? You do design. So let's say that you've got somebody who comes in and spends 3 hours with you helping you in a design. That person gets a 1099, okay? That person is not an employee. They're gonna leave his office and go to somebody else's and do the same thing. So just kind of keep in mind there is a very defined difference. So when do you issue a 1099? It's for services only, so it's not for merchandise or product. You're not issuing a 1099 for that. And the payments must exceed $600 to one recipient in one calendar year. So if he had that person come in and help him for 3 hours and he paid them $200 an hour, he's got a $600 independent contractor, he's got a 1099 to issue, okay? So if it's $600 in one calendar year to one person. And the payments must be to a U.S. person. And generally, small business, you're going to be paying people who are local. You're not going to be paying international people. Exceptions, you don't need to issue 1099s to corporations or an LLC that's treated as a C Corp or an S Corp. You don't have to issue them for merchandise. You don't have to issue them to real estate agents. Obviously, wages are paid to employees, so if you have an employee, they don't get a 1099 and a W-2 if they're an employee. Employees always get W-2. 1099s always get 1099s. And then tax-exempt organizations. So I'm not going to talk too much about the differences between independent contractor employees because they're going to handle the legal side of that because it is a delicate legal side of it. But just keep in mind that there's a very big difference between employees and independent contractors. So sales tax, everybody's favorite. What I always remind people is whether you're making money or not, you still have sales tax. You can be in a loss position for the year and there's still sales tax that needs to be handled. Whether you're paying that or you're collecting and remitting. And a lot of clients are like, well, why should I have to deal with sales tax? I didn't make any money this year. It doesn't matter. Sales tax is payment for a product. So sales tax is a consumption tax imposed by the government on the sale of goods or services. So it depends on what service you provide on whether it's taxable or not. And there are sales tax is very detail oriented, so the details really matter. When I have a client who calls me with a sales tax question, they're like, well, we just do this. No, what do you really do? I need to know start to finish what you really do, because all of those details make a difference. If you've got a contractor, does that contractor, are they doing a capital improvement or repair, maintenance, and installation? Okay, what does that mean? So let's talk about what that means. And I go through all the details of what that means with a client. Because if they do a capital improvement, their services are not taxable. If they do a repair, maintenance, installation, guess what? Their services, their labor hours are taxable. So it's even doing the same type of work, it's just categorizing it properly. So it's really important that you spend the time thinking about sales tax. And if you're selling product, you're collecting and remitting. Unless you have an exemption certificate handed to you, you're not off the hook if you're selling a product. So keep that in mind that, if you are selling to places, and I've got some exemptions down here, sale for resale, that is an easy one to define. If you're in the middle of the process, you're going to buy something from a wholesaler, you're going to resell it to a storefront, then you've got an exemption in there. You need a resale certificate to purchase that product. And then when you sell it on to the next person, then they either need to give you an exempt certificate or you need to collect and remit. You're required to pay tax on your taxable purchases. North Carolina has a nice little box to check that says use tax. Everybody ignores. That is, if you're not charged sales tax, then you should have been. So you're supposed to self-impose use tax is paying it yourself, sales tax is collecting it from others. So they're two sides of the same coin. If you're not so what happens if you're not in compliance? I have had more sales tax audits on clients in my 25 plus years than I have had IRS audits, because the states need money. So they will come out and they will spend a lot of time in your house, office, wherever you do business, and leaf through all of your invoices. And a lot of times it's not sampled either. They're just going to come and camp out, and it's going to be a long process. And even if they don't find a lot, and often they don't, it's a real nuisance, and it's time consuming, and you could be doing other things with your time. So my keys for being good with sales tax is make sure you're collecting and remitting if you're selling a product or a taxable service. That can be remitted once every month, quarterly, twice a year, or annually, depending on your level of sales. So when you sign up for sales tax to collect and remit, just be careful about what you're choosing as far as remissions. You don't want to choose that you have to remit every month if you really only have to remit quarterly, because it'll save you some time. You don't have to sit down every month and do it. So when you register with North Carolina for sales tax, just like I said, keep in mind, it'll give you some parameters on how much you think you're going to collect, and then break it down on when you have to remit. Yes?
Thank you. I was a little confused with the repair service sales tax.
Yeah,
Do you mind just repeating that just a little?
Yeah, so when you have a construction contractor that's coming in and they can either do a capital improvement, which is usually a remodel, which is more than one thing they're fixing, or they're doing like a full kitchen remodel, that sort of thing. Those are exempt on their labor for sales tax purposes. But if you've got somebody who's coming in to replace trim that your dog chewed, which my husband has done in somebody's house, and that's all they're doing is replacing that trim, that's a repair, maintenance, and installation, his labor is then taxable. So it's really all about the labor. Invoice to you. Yep, as the user. And then he has to then remit that to the state. So, and people think that sales tax is something they're collecting like revenue. It's not. You're a pass-through on that. It is what they call trust taxes. You are entrusted with somebody else's money, and you must remit that. And so what happens if you don't remit that tax over? Same with payroll taxes. What happens? Well, the IRS sends you notices, especially if you're doing payroll taxes and and your employees have filed their taxes and there's no money on their account, and it says that you did. Same with sales tax. You know, if you've remitted all these months and then quit remitting, and all of a sudden magically the state comes to you and says, look, we don't see any sales tax. What happened? Well, they can literally lock your doors, sell your assets to pay that tax that you owe, because it's not yours. It's somebody else's money. That's really what it comes down to. It's one thing if you personally owe the money. It's another whole thing if you've collected that money from somebody else and you have not remitted it onto the government, whether it be IRS or state. So keep in mind that trust taxes are really, really important, and sales tax is one of those, because it's not your money. It's other people's money. So estimated payments. Small business owners hate them. I am not a fan as well, because then they call me and say, how much did I send in? And I was like, well, I don't know. How much did you make? So it really is important. First off, quarterly you have to make estimated payments. Usually it's to cover flow-through income, which come from single-member LLCs or sole practitioners, S-corps, or partnerships. Those are all considered flow-throughs. Those are tax purposes. They can be something very different for legal purposes. An LLC can be all of these things. But keep in mind that this is a tax for tax purposes. So usually when my clients who have, and often it's S-corps, that LLCs that have become S-corps usually, they're like, okay, what do I need to do quarterly to cover my taxes? Well, they have payroll in an S-corp, so anything they receive from payroll has withholding on it already, so that's covered. But it's the operating income off that business that they have to pay have to pay tax on for estimated payments. So I sit down with them. Usually I set them up the prior year with what we call safe harbor. The IRS does give us a little bit of leeway on that. So depending on your level of tax for the prior year, you can either pay 100 or 110% of your prior year tax, which is usually what we do with clients. We'll set them up with 110% of their prior year tax, and then let them roll through the first couple of quarters, sometimes 3 quarters, so April, June, and September, and not have them remit anything extra other than that. And then we sit down with them in the winter time, usually between Thanksgiving, Christmas time, and say, okay, look, where are you really this year? You know, what do your books say? Are you up for the year? Are you down for the year? What do we need to do with your estimated payments that are coming up for January 15th for your fourth quarter? And so if they've got a down year, then we can rely on the second part of the safe harbor calculation, which is 90% of their current year. So we can say, okay, your 2025 year, and this will be, you know, for this year coming up, your 2025 year, you're down $100,000, so we can reduce your estimated payments and have you pay in less. But if it's an up year and they know that they're making more, we can still rely on that 110% rule. So there are some parameters that allow that to be a little bit easier, but it is still not set in stone. They could still write a check at April 15th, and often they do. Or they could be overpaid on April 15th, and we need to file them and get them a refund or apply it to the next year. The other time estimated payments are important is if you've got some investment income that's significant. You know, those are the 2 situations in which I have clients that pay estimated payments. So it's either business income or it's significant investment income that is coming through to them on a 1099, usually brokerage accounts. And then if you don't meet safe harbor, you don't make one of those rules, the 100% or 110% or the 90% of current, then you've got penalty and interest, and they will assess it. It's automatically calculated. You'll get a bill in the mail. Often we calculate it on tax returns. It's 90% of the time it works well. Sometimes it's not because the interest rates change regularly. So, and keep in mind that I used to not worry about interest on underpaying because the interest rates were so low. My clients could be making more with their money in the market, but interest rates are very high now. So the IRS is prime plus. So right now, interest rates on the IRS's bills that you owe them are like 7%. So it can be significant. And those will adjust a little bit as the interest rates go down, but if they stay up, then they stay up. So keep in mind that that's important now, especially because it does cost quite a bit of money. But there are some waivers possible if you've got good history. Usually it's once every 3 years. You can request a waiver of penalty. They will not waive the interest, but they will waive penalty, and that's North Carolina and IRS. So, so Smith Anderson spent a good bit of time about entity choices. I just wanted to kind of solidify that by saying, what do you file based on the type of entity you have? So if you've got a single member LLC, it's taxed as a sole proprietor, and it's either on a C or an E. E can be rental. So keep in mind that a lot of people put their rental properties in a single member LLC. So people who have beach houses, they put them in a separate legal entity to keep the liability off of them. Heaven forbid somebody get hurt in that beach house. You don't want it to come directly back to you. So they'll put their houses or their rental properties in LLCs, usually single members. They file on a Schedule E. Short-term rentals can sometimes qualify for a Schedule C, so there are benefits to that. Then LLC is taxed as an S corp. You'll file an 1120S, so a separate legal filing, different administrative burden, completely different from your own personal. It'll produce a K-1 that will then flow that income into your personal return. LLC taxed as a partnership is a 1065. Same kind of tax theory. It's a separate tax filing, and then that K-1 will then flow into your personal return. And then an LLC taxed as a C corp, it files an 1120 and is taxed on its own at its own rates, which is 21% right now. All of the other entities that we talked about, other than the C corp, are based upon your level of income on what the tax rate is, and that's adjusted marginally. LPs, limited partnerships, general partnerships, or any kind of partnership files on a 1065. And then you have to consider a couple of things when you choose an entity, and Smith Anderson spent a lot of time on that. But one thing that I've found that people don't think about I had one client who was a single member LLC for many years, hated estimated payments with a passion, couldn't keep up with the payments, just outside his comfort zone, didn't like them. So we elected S-election. He can now get a payroll paycheck. He withholds most of his income tax within that paycheck. He feels much more comfortable. He doesn't write a check quarterly, and he gets an actual paycheck. So it's psychologically, you have to kind of prepare yourself for what is that going to look like for me. If you've got these other flow-through entities, you're almost always, as long as you have profit, you're almost always going to have to pay estimated payments on them, other than the S-Corp, because an S-Corp can issue a payroll check. And even if you've got income above and beyond that payroll, you can still do a bonus at the end of the year, one payroll check in December, which a lot of my clients do that need to pull some income out. They'll take one paycheck, and almost all of it will go into withholding to cover all their taxes throughout the year. So there's, like I said, there's some tax ramifications to that and some things to keep in mind, just psychologically, you know, what you're going to have to, how you're going to have to pay tax. So I'm going to talk just a little briefly about, you know, what the future of taxes look like. We have no crystal ball. Benji's laughing back there because we don't know. We can tell you what we have right now, and that's what I always tell my clients. You can't guess what tax law is going to do because you're never going to get it. So we base all of our decisions for all of our clients based upon what we know right now and what we have right now. So, you know, marginal tax rates are up in the air. Standard deductions, personal exemptions. You might hear in the news SALT cap a lot, state and local tax caps. Expanding the alternative minimum tax, capital gains rates and what's going to happen with those. There are some additional Medicare taxes out there. Estate and gift taxes, that's a big topic because if things don't change, it's going to be dramatic. And then, of course, for businesses, the C Corp rates, what's going to happen with those, business loss limitations. Some of you may have what we call Section 199A deduction right now if you've got a flow-through entity. And then depreciation is always a hot topic as well. So I just want to kind of compare and contrast if nothing's done versus what we have right now. And when I say 24 to current, it's 24 and 25 because a lot of these laws don't change until December 31st. So as you can see, the tax brackets for 2024 and current is based on the 2017 Tax Cuts and Jobs Act. And so these have been in effect since 2018. And essentially what happens is everybody gets 2.5% to 3% reduction in your federal income tax across the board. And if nothing's done, everybody's going to feel an increase in their federal taxes of about 2.5% to 3%. So we'll go back up to the 10, 15, 25, 28 rates, and you see that the 2024 to current, there's less brackets, and each one is wider. So that means more taxes taxed at the lower rates. So, like I said, if nothing is done, it's going to be painful for a lot of people. The standard deduction. If nothing's done, you see we've got single at 14.6, married at almost 30, and those ratchet up a little bit for 2025, just so you know these are 2024 numbers, 21.9, and then those get knocked back down if nothing is done, a significant amount. So not only are you getting more income taxed at a higher rate, you have less deductions. And when they expanded the standard deduction to as wide as it is right now, then it took it down to only about 20% of the U.S. population now itemizes. And itemizing is things like your charitable contributions, your mortgage interest, your real estate taxes. So these changes may simplify taxes for a lot of people, plus increased the standard deduction that a lot of people get that they wouldn't have gotten before. So like I said, the increased tax rates plus the reduction of the standard deduction is going to hurt a lot of people for taxes. And that's across the board. It doesn't matter at what whether you're at the 10% bracket or the 33, it doesn't matter. Everybody's going to feel it. Personal exemptions right now in the current tax law, we don't have any personal exemptions. They did away with that to increase the standard deduction more. So if 2026, if nothing happens, then that'll go back up to $5,300. Child tax credits. Right now we're $2,000 per child under 17. My daughter turned 17, so it was pretty painful for me to do my taxes because I didn't get her anymore. It was extra $2,000 I lost. Now, college students or children over 17, you're still going to get $500 for them, but you're not going to get the full $2,000. If nothing happens, then we're down to $1,000. And then the actual cap, the phase-out period is also much smaller, so a lot less people are going to get the child tax credit. And then the credit for other dependents is the $500. The SALT deduction. A lot of you, like I said, in the news you've probably heard about this. It's your state and local tax deduction, and it's for itemized filers only. So if you don't itemize, not a biggie. If you do itemize, then it is capped at $10,000 right now. And that's your state and local taxes. So that's your state withholding that you pay for payroll. That's your real estate taxes. That's your personal property taxes on your vehicles. A lot of people living in higher taxing states like New York, California, got hit really, really hard. I had a couple of clients who used to get $150,000 to $200,000 SALT deduction. They now get 10. So huge difference. Mortgage interest deduction, that could change a little bit. Debt up to $750,000 is all we can get right now, and then they start limiting it. Then it could go back up to the $1 million. Then the itemized deductions, the less common deductions, they eliminated things like the miscellaneous employee expense deduction and 2% items. So those can come back into play. Alimony, huge thing for those who are divorced. If you were divorced before 2018, the person who pays it gets to deduct it. The person that receives it has to pay tax on it. If that goes away, and it's scheduled to go away at 12/31/2025. So if you're in the process of divorce, you might want to hold off, depending on which side you are on. I had a couple of clients who pushed it through really quick before 18 to make sure that they got the one who was paying got the deduction. Then it's not deductible for the payer, and it's not taxable to the recipient. So it's going to change structure. And then moving expenses ended up, those got reduced only to U.S. military members who were being relocated. That'll go back to being available to qualifying individuals, which is usually a 50-mile move due to a change of work. Alternative minimum tax, just general terms, alternative minimum tax, most people don't fall into this unless you've got some very strange tax year, like a big, huge capital gain. But essentially what the alternative minimum tax is the government says, we don't want you paying less than 28% tax on any of your income, and people who have a lot of capital gains can get lower than that because it's such a big number. So they increase that and make them pay minimum 28% if they fit the parameters. And then the one thing that's kind of really shocking for people is the estate tax limitation right now. In 2025, it's almost $14 million. So you have an estate tax exemption, which means if you pass away, your estate's less than $14 million, you don't have to file an estate tax return. Now, there are some other reasons you may want to, especially if there's a surviving spouse. We do that for a lot because let's say that we've got a husband who passes away. His estate's worth $8 million. So he's not using his whole 14. He has all that extra sitting there. He's got $6 million sitting over that he didn't use. So, but he has a surviving spouse. His wife is still here. And if the estate tax shrinks or if their investments expand a lot, we can take that $6 million he didn't use and apply it to hers. So let's say that nothing happens and it goes down to $7 million. So when she passes away 4 years later, she only has $7 million. But we can take that extra 6 from his he didn't use and give her 13. So like I said, there are some reasons to file even if you don't have to. And that is the Form 706, and it can be very, very tedious. So it just depends on, the level of income in your estate on whether that's important or not. But it is going to be a very drastic change. If nothing happens and it goes down to $7 million, there's going to be a lot more people filing estate tax returns. And then this is my last slide, so we can take on questions after that. So think about that. But the 199A is a pass-through business deduction. Been really, really helpful for small businesses. And it was essentially put into place. The corporate rate, as you know, went down to 21% from like 35 to 37. Well, to make up for that, for the people who own partnerships and S-corps, the flow-through entities, they said, okay, we're going to give you a 20% deduction on your qualifying business income, essentially the operating income of the company. So that helped, flatten it out and make it equal. In fact, there were a lot of people who contemplated becoming C-corps when the law changed, and when we did the math, it was about the same. And as I say, Benji probably did that for people too, yeah. So a lot of people were thinking, oh, we're going to become a C Corp because it's 21%. But then they have to think about the fact of anything they take out that's not payroll is taxed as well at a second time. So when it all washes out, it's about the same. So that was actually a really big benefit to our flow-throughs. Section 174, it has to do with R&D expenses. If you've got R&D expenses, it's been really, really painful, assuming your accountant has filed those properly. They delayed the deduction for the expenses related to R&D. You still get the credit, but the deduction that can be very big, it used to be taken 1 year. It's now spread over 5. So we're hoping that goes away. We're hoping that it doesn't come back. But right now, for 2025, it's still in place. After 2025, it's set to sunset. So we're hoping that one sunsets because it's been very painful for a lot of our clients. Depreciation, a lot of people know about bonus depreciation, and it used to be 100%, and it's kind of been all over the board. It was put in place right after 9/11. It was 100%, 80%, 50%. It's been all over the place. They adjusted according to what the economy needs for a boost. So for 2022, you could claim 100%. Every year it ratchets down 20%. So after 2026, there's none left. So just keep in mind. However, we still do have Section 179, which is, people don't talk about it, but it's been around forever and ever. And if you're a small business owner, you can still use 100% deduction with 179. And it really should be used instead of bonus. So if that's something, if you've got some assets you're putting in business, in place, maybe you're doing a whole bunch of office furniture, or a new copier, or a new scanner, things like that that are a little pricey, then make sure that you're getting the full deduction on those. Vehicles are different. You can combo those bonus and 179 to give you some advantage on those depending on what kind of vehicle you put in place. And then the work opportunity tax credit still in place. You get a 40% credit up to $6,000. So keep in mind that those are for certain classes of folks. Often it's used for veterans. It's also used for felons. So there's a laundry list of those. So if you're hiring, that paperwork has to be done before you hire them. So just if you're doing some hiring in the near future, just start looking into the work opportunity tax credit. It does sunset at the end of 2025, but you could take advantage of it in 2025, and know that you need to qualify those people beforehand before you hire them. So just know that it's out there. Okay, questions?
I have a mic.
Okay, there you go.
Hi, thank you so much. My question is about working with non-for-profits. When you're working, how does the taxation work when you're working with a non-for-profit that is attached to like a government entity?
I guess it would depend on what you're doing and how you're doing it.
Communications, digital stuff.
And you're working as a consultant for them?
For a community redevelopment agency.
And you're not an employee?
No, contracted.
Okay, so they will issue you a 1099 for your work, so expect that.
Okay.
You're going to have to pay tax on that. There's no withholding on that.
Okay.
So that's a higher rate because it is a 1099. It has self-employment taxes wrapped into that. So just keep in mind that that's a little bit more expensive. I usually tell people to set back 25 to 30% of what they get on that for state and federal, just to make sure you're good and covered. But as far as your services you're providing to them, most likely those are exempt. You know, you wouldn't have to charge them sales tax. I can't guarantee that, but my gut tells me most likely not, because they're exempt entities.
Okay.
Yeah.
Okay.
Mm-hmm.
So we're going to cross-pollinate from a lot of different presentations, also the employment that's going to come. But you just touched on it a little bit, that I think is a really important concept for people to understand. Yep. And it is the concept that, particularly in an LLC that's taxed as a partnership, can you talk on the consequences of giving equity in that partnership to employees and how it affects their status as a 1099 and someone who needs to pay self-employment taxes. So instead of being treated as an employee of this entity, you're going to be treated as a 1099 not a 1099, an owner.
Owner, yes.
So can you explain
Sure.
that just a little bit? Just and
Yep.
it gets complicated, but it's really important to understand the consequences of giving ownership in that LLC to employees.
Yeah, and we run into this a lot, and people decide throughout the year without consulting us that they're just going to give somebody ownership. And fantastic, but that person can no longer receive a W-2 if they're getting a K-1, because if you're getting ownership of a partnership, that's an LLC, taxed as a partnership, then they are not allowed, those owners are not allowed to have W-2s. They get what they're called guaranteed payments, which are self-employed income, which are higher tax rates, and they're not allowed to get W-2s because they're getting a K-1. They're also not getting a 1099. So you have three choices for ways to pay people: a W-2, a 1099, or an owner that gets a K-1. Now, an S-Corp's a little different because you can get a W-2 and a K-1 in an S-Corp, but in a partnership or an LLC, you cannot. You only get the K-1. And those are kind of all exclusive. If you issue somebody a W-2, you're not supposed to issue them a 1099 or a K-1 unless, of course, they're that S-Corp exception. So and keep in mind that when you get the K-1, that's self-employment income. So higher taxes because you're paying both the employer's portion and your portion, and nothing's getting withheld. So when I tell folks whenever they're getting those K-1s that they need to start thinking about the 25 to 30% holding back to make sure that they can pay their taxes when the time comes. Because you've got North Carolina tax rate at 4.25 now, I think is where we're at. It's been rationing down every year. And then whatever your ordinary rate is for that. So yeah, it is very important that people understand that. There's some litigation, I'm sure Benji's folks will discuss, or if they haven't already, that arguments that you can pay somebody out of an LLC a W-2. However, I tell my clients it's not permitted because it's sketchy on if it's legal or not. So yeah, that is an important thing to keep in mind, that those things are all exclusive except for the S-Corp that gets to kind of do the W-2 and the K-1. Any other questions?
Hi, yeah. I think maybe I misread something up there, so people who have services as opposed to products, if single proprietorship LLCs do need to still have sales tax on their invoices?
It depends on what services you're providing. There's a long laundry list of services that are taxable, and every state is different. So you would have to check your service against the rules for North Carolina sales tax. And you can go out on the DOR website and pull down taxable services for sales tax purposes.
Okay, great.
Because and like I said, every state's different. So once you start crossing state lines, things get even more mucky, because sales tax is destination based. So and income tax can be too. Again, every state is different. But if you sell things across border to another state, then you could potentially have sales tax in other states as well, depending on what activities you have going on in that state. So it has a lot to do with presence, physical presence, and whether that be you're going over there to do business and you've got a new client and you're spending a couple weeks a year doing work over there for a client. Guess what? You've just created yourself an attachment to another state, and you're most likely going to have to file a state tax return for that state. And you'll consequently be saddled with some sales tax if you have a taxable service there, and then you could also have income tax ramifications depending on the threshold for state filings. So years ago, there used to be an exemption for income tax purposes for states unless you had a physical presence there, inventory, people, trucks that went into the state. About 3 or 4 years ago, case came out, Wayfair. We all know Wayfair. You see the commercials selling furniture. And a lot of states piggybacked off of that. Wayfair said in the particular state, and I can't remember what state it was, maybe Connecticut? Yeah, I don't know. Benji doesn't know either. So it was if you had $100,000 of sales in that state, even if you never stepped foot in that state, you were going to have to file an income tax return there. So that started a chain reaction across the United States. All the states decided, oh, we're missing out on a lot of money. So a lot of states put in various thresholds on which you have to file for income tax purposes. Some of them are $100,000, some have no threshold at all. They said if you sell anything into our state, you have income tax in our state. Some have a $500,000 threshold. New York and California, believe it or not, are actually a little more friendly. That's the only time I'll ever say that for tax purposes, or like one's over 500,000, the other's over 1 million sales in the state. But yeah, once you start crossing state borders, it becomes really, really messy, because then you have to look at that particular state's laws and rules and see if you've got sales tax over there and income tax over there.
Great, thank you. Another question about with an LLC for income tax filing. At what point do you start doing like the quarterly, or decide which one? Is that from the beginning when you start the LLC, or do you need to have some sort of actual income, or is it required filing regardless?
You have to have taxable income.
Okay.
So I usually tell people that if you're starting up very small business, you're not going to have taxable income most likely that's significant or material within your first year. You can still rest on those safe harbor rules for your first year. So as long as you cover 100 or 110% of your prior year tax, or 90% of your current, then if you start to write checks with your return in March and April when you file, then that's when you start saying, okay, it's time to start thinking about estimated payments. And your accountant should help you with it, be able to help you with those. I just automatically calculate them for my clients. I just set it up so that because then that covers me. They can decide whether they're going to pay them or not, but I've given them what they should be paying. And then they can make those payments or not. And if they don't, then they pay the penalty and interest. But it's on them to make that decision. I can't force them to write a check.
We have time for one more question. All right. Oh,
Okay.
there we go.
I'll put my legal disclaimer up, Benji.
So this is kind of going off of what you just said prior. So if you are making the estimated tax payments, if you make that payment and then it's wrong, when can you make an adjustment to that? If you like pay too much and you need to walk it back, or vice versa. And then also, if you're in the very beginning stages of a company like me, I just have no idea how to estimate it, because I mean, I would hope that I'm really going to be making a lot more money each year.
Yes.
I'm growing, so I'm just, I don't know, feeling a little confused on how to do that.
So like I said, the beauty of the first year of making money in your own business is you do have that cushion. So make sure that you're covering whatever you paid in tax last year, 100%, or if you're over 150,000, 110% of your taxable income last year. And then when you file your taxes, you'll find out how close you were in that. Then that will then build the next year. Okay, and so if you've paid estimated payments, and let's say you've paid too much in, you feel like you've paid too much in, then the next quarter you can correct that by paying less. But if you feel like, and I have some clients that do this, they're like, oh, I just had a big contract and I'm going to be, in this next quarter, we didn't anticipate it, and I really don't want to write a check, in April. So then I'll give them a blank coupon, and they can make an estimated payment at any time. But they're scheduled to be quarterly, so April 15th, June 15th, September 15th, and January 15th. And so what the IRS does when they do your tax return, it calculates on their penalty, it's a Form 2210, and it calculates your penalty and how much you're supposed to have per quarter. And if you are short every quarter, it calculates more and more interest and penalty, and it compounds throughout the year. So sometimes I tell people, they're like, ooh, I really undershot, then make a payment now, and it'll at least stop that from accumulating going forward. Yeah. Okay, all good?
Okay, let's give it up for Lori.